Right, so yesterday, Ben, right, we had a pretty big meeting, the Fed meeting. You know, we're just gonna explain to you. You asked me some questions about basically what Jerome Powell is actually saying.
Yeah.
He says a lot of words. Some are good and some are really bad. It's kind of hard to cut through, but we're gonna try to cut through them all, and let's just roll the clip.
Yeah, let's roll it.
Good afternoon.
Good afternoon.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong.
All right.
And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain.
All right, pause it there. All right. So my biggest maybe pet peeve is when they say inflation has eased substantially.
Insane.
Because if we go to the first slide here, just to understand, like I might understand that very easily. Is like he's talking about the pace and the rate of inflation, which is a year-over-year comparison. But I hear it all the time with politicians too, where they say like inflation's ease, and it's just like I just think it's very misrepresentative of what's actually going on in our system. So,
is there any data that they're referencing when they say that, or is it just that something they say?
it's just headline CPI is all they're referencing, which is like what they determined as the price of living. So whatever they determined back in 1960,
Right.
essentially. But if we look at the chart here. So the blue line, so that's actual inflation. That's like the cost of living.
Yeah.
So you can see it's going up, right? I'm not a genius.
Yeah, up and to the right.
Yeah, up and to the right. And that red arrow is from 2021. And you can see it's going up. Black line here, that's what they're referencing. That's what's eased substantially. But that's your year-over-year growth. But just because year-over-year growth went from 9% to 3.5% does not mean inflation's going away. Inflation is still there.
Right.
Okay. So that's like really important.
So essentially they're using a metric they know will help their case.
They're marketing. It's like, inflation, it was really bad. And you guys know it was really bad, but like it's down now. But like everybody really knows it's not down, right? And so like that's just what they're talking about there. But also, what's important about that was that inflation's up. You need to look at what is it up since 2021, because that's when we really started this whole inflation. And it's up 19.4%.
Yeah.
So if your wages aren't up 19%, that means you've lost your purchasing power. And I would assume most of Americans, their wages are not up 19%.
Nope.
No. And so
Nope.
I think the big thing we should do with this one is maybe show how did we get to this situation of high inflation. So if you go to this next slide here, this black line, so blue line is still the CPI year over year. Okay, black line is M2 year over year. So basically, just think of M2 as it's money supply, it's money entering the system. Okay, you'll see the black line, and so we had a pandemic in 2020, right? And then what did we do? We printed money, stimulus, out the wazoo. We did all that, right? So that's new money coming into the system that previously didn't exist. So your black line goes up 27% year over year.
Powell's money printer.
Yeah, the Powell's money printer. It was the government's money printer. Everybody was joining the party, right? And so that's what you see with the black line, right? And you can see how high the black line is versus the rest.
Yeah.
Okay, but what did the black line do since? So after 2021, they stopped printing money, which is like, okay, this is like brilliant concept here, right? What are we doing? Right, and you can see then the blue line, which is CPI, peaks shortly thereafter. So this whole it's like this, I hear this whole wording as e-substantiate is them just high-fiving each other and literally saying like, look, we stopped pressing the money printer button. We stopped doing control print. And it's just like, it's kind of pathetic in my opinion, because like anybody could have figured that out. You print a bunch of money and all of a sudden you stop. Yeah, inflation's going to go down year over year, but it continues to actually go up.
Yeah, so it's sort of like a big dunk in a basketball game when you're still down 32 points in the fourth quarter.
Yeah, you're still losing.
Still losing.
Still losing, and I don't even think you're going to get a clip out of that.
Yeah, exactly. Roll it.
He talked about employment, but I think we'll just keep listening.
Yep.
We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace.
Wow.
Okay.
Shocking. All right,
So-
so this is what I had a question on.
Yeah.
Can you just explain what he means by the second part?
The securities holdings.
Yes.
So reducing securities holdings. All right, this is this third chart here. So basically, the Fed has a balance sheet. So just think of it as like a portfolio.
Sure.
Almost. Like they're just a massive bank, and they hold U.S. treasuries, they hold mortgage-backed securities, they hold some cash, right? They basically, just think of it as like a J.P. Morgan 2.0.
Sure.
Okay, but it's the Fed. So what happened again was you'll see this blue line is how big that portfolio is. So before in 2019, the portfolio had a size of $3.8 trillion. It's a pretty big amount of money. Pandemic happens, they increase that by another, let's just call it 2 trillion to 7.2 trillion. So that's just new money coming into the system that didn't exist before. Then by 2022, so 2 more years later, another 2 trillion. So now their balance sheet is $9 trillion. Like
And
that.
what do they aim to do by growing it?
Essentially, it's to stop prices from going down. Like they want to stabilize the economy. So think of it as like, let's say the price of Apple was to go down, right? They're just buying and buying Apple to make sure the price of Apple doesn't go
Stays
down
constant. Yeah.
too much.
Yeah, of course. Okay.
Right, but they're just doing this for the U.S. Treasury system, and they're pumping in $4 trillion.
And they're trying to influence inflation,
Right,
basically.
but then what ends up happening is they're now in 2022, and somebody wakes up and decides to look at their balance sheet number and like, oh, it's $9 trillion now. Holy shit! So just put this into perspective. So your 3 largest banks in America are J.P. Morgan, Bank of America, and Wells Fargo. Their balance sheets, I have it up there in the middle there. J.P. Morgan's balance sheet is 3.9 trillion big, right? All right, Bank of America is 2.4 and Wells Fargo is 1.7. You add all those together, you have an 8 trillion. So your Fed is the size of the 3 largest banks in America. That's a massive player in the market.
Oh, yeah.
Like a massive player. So when he's saying they're going to reduce the size of the balance sheet, all they're saying is now instead of buying, they're going to be selling. So if we go back to the Apple example, that person who was buying Apple the whole way down,
Yeah.
the price of Apple is now down here, they're now selling. So whereas the price of Apple it goes lower because there's a constant seller in the market,
Yeah.
which is them.
Yep.
And since they grew their balance sheet to 9 trillion, that impact of selling
It's gonna
is
be
massive.
Huge, right.
It's massive. And so that's what happens on the next chart here. If you see it, this is the price of treasury securities, okay? So the blue line is the price of treasuries, black line is the year-over-year increase of that balance sheet. So you can see the black line, right? That's in like 2019, 2020. The price of the treasuries, they're fine, right? They're just hanging in there. And then all of a sudden, they stop buying, and the price of treasuries goes down.
Yeah.
And then they continue to stop buying, and it keeps sliding,
Yeah.
okay? Because they're not buying anymore. If they're not buying, nobody's buying, and this is what they do. They artificially pumped up the market or held up the market so that basically if they're selling, that's what happens. So when they're saying they're going to stop the pace of the selling, it's a type of easing essentially that like they're still going to like sell, but not going to sell as much.
Yep. So what you're saying by all of this is that it's a problem that the Fed themselves has gotten themselves into,
Yeah.
and they can't get out.
Yeah.
Inflation isn't responding to their rates, and they're kind of floundering.
Yeah, yeah. They decided to grow their balance sheet. They decided to print money. They know, like, they should know better that, oh, we introduce all this money, inflation's going to go up.
Right.
Now to act surprised that inflation's up and where it is a joke.
Yeah.
This is what they're supposed to do, is know this, right?
Yeah.
And so what this is just showing is that, okay, they want to ease, but that's all that's going to do is just push the price. That might just push the price up even further. So
Yeah.
that's even a problem. But also their balance sheet is still so large. Like, it's still going to be shrinking. Like, you're basically in an awful situation
Yes.
where you don't have anybody who wants to buy the U.S. Treasury. Almost is essentially where you're starting to come into. And that's what the market's seeing and reacting to, because it's not good. And we'll get into a little bit more about what's happening with like treasuries and the government and stuff like that. But like, essentially, the Fed put themselves in this situation. That's what when they're talking about balance sheet and easing and so forth. That's what it is. Make
Not
sense?
good. Yep.
Cool.
Let's keep it going.
Let's keep it onwards and upwards.
A restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter,
and then all of a
as
sudden it
strong
looks
as the
pretty
second
good.
half
Yeah.
of 2023.
Pointless. It's just-
Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight,
He's really
but supply and
strategically
demand
using
conditions have
words
come
that
into
are
better
less
balance.
bad than reality
Payroll
may
job
suggest.
gains averaged 276,000
Supporting the
jobs per
strength
month,
of the U.S. economy over the past year. Like,
while the unemployment
Okay.
rate remains low
Yeah,
at 3.8%.
we'll pause it here. He's talking about employment. What did you say?
he's just like his language is. He's saying negative things in a way that makes it sound less bad. You know?
Well, yeah, it's his job.
Yeah.
He's not here to tell you anything of meaning
No.
or anything of anything.
No.
He's just there to say words.
He's
He's just a puppet.
he's trying to pump things.
Yeah. But he
And
was
it
talking.
worked.
He was talking there about strong job creation, which gets very interesting. Like, then when we look at the whole labor market, if we have a whole macro theme stack, by the way, slide 87. So we go into a lot about jobs.
Yeah.
Okay. So
Yeah.
thing with jobs, is, it kind of depends right now where you're looking.
Sure.
So right. There's some cracks in the system almost. So that green line, so they'll report jobs, and this is all job gains. Is the green line in California? So they'll report the green line, and after they report it, they'll revise it down, and they'll revise it down to that dotted line. Now that green line and the dotted line are showing two different things, right?
Of course.
I can understand. Green line looks pretty good. That dotted line doesn't look as good. I was like, yeah, you're reporting stuff, but all you're going to do is revise it down. So what are you telling us anything?
Yeah, and I think a lot of people don't realize that.
Yeah.
That on these
not at all.
reports, they are almost every time revised, in the next month.
In the coming month, they're just revising it, but
They revise it higher or
everybody's
lower.
on to the next one.
Yeah,
And
it's old news, and people don't even look at it, but
Yeah.
it really makes you take each report with a grain of salt, right?
Pretty much.
Okay.
It's just it is what it's kind of crazy that they do that. Maybe slide 92. Here's slide 92, so you can kind of see here's full-time employment on the right side year over year. It's down 2%. That's not good. Permanent job loss is going up. Right? There's cracks in the scene here in this whole employment picture. I think I said I find maybe go to slide 80, which is another one, which is small businesses. Small businesses are hurting the most, and this has to do a lot with our K of like the rich getting richer and the poor getting poorer. But
Right.
you can see like hiring plans in small businesses are down, and they're not doing well at all. And their earnings, small business earnings, aren't doing well, and that's most of the jobs, or not most of the jobs, most of the companies in America are small businesses.
Right.
So it really depends where you're looking, and he's looking where he looks, but. There's definitely some cracks. It's not all rainbows and puppy dogs.
It's not exactly how he said it.
No.
That I think is the key here.
Yeah.
Everything is not exactly how he's saying it in this meeting.
Yeah.
He's kind of there to make things sound better than they are.
Yeah, pump. All right, we'll go to the next.
Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%.
All right, pause.
This guy.
He said longer run of 2%. We have
Yeah.
to say what this means. So if you go, it's probably the next slide on this. So this is something they come out with predictions. I think it's once a quarter. It was the last Fed meeting. So yes, this is actually a chart from your Fed. It took 756 economists to
Wow.
make this thing.
Look at that.
I kid you not.
Looks
But
awful.
yeah, I know. It's even hard to read. But the blue line is essentially where inflation is, or CPI headline is, and then those little bar things are their estimates about where inflation's going. Okay, you'll see magically. So the Fed's goal is for inflation to hit 2%. Magically, by the long run, which is past 2026, everybody is at 2%. They did it.
Wow.
So when he's saying
How did
over
they
the,
do that?
I don't know how they did. I mean, they have some models, don't they? But so that's what he's saying. Whenever he says long run or over time, we're going to get to 2%. He's saying in like 2 years. I mean, I don't like. You ask market participants if they can predict the price of, let's say, crude oil in the next 3 months, 4 months, year. They're going to be like, no.
Yeah, no.
He's
trying to draw it out 4 years.
He's trying to draw.
I think on top of that too, I don't think a lot of people want to wait 4 years for inflation to go down. I mean, it's already affecting prices so much that people are pretty stretched.
But here's also the thing. Inflation's not really going down. Inflation continues to tick higher.
Well, yeah, when you look at our
Actually-
updated inflation nowcast versus
Well, no. I meant like on an absolute basis, right?
Oh.
It goes back to that first chart, right?
Uh-huh.
Like to get to that 2%, so year over year, maybe inflation's up 4%, then it's up 3%, but the inflation's still going up. And then maybe it's up 2.5, and then finally they get, it's only up 2% year over year. Right? Again, your wages better be matching that.
seriously, yeah.
Otherwise,
People are
your
screwed.
purchasing power is down. So that's that. It's a long road and a lot of hurt over 3 years for people who like really aren't getting that bump.
And it's to no fault of anyone really but the Fed by hiking rates too late.
Exactly,
You
exactly.
mentioned earlier.
Right, because as we alluded earlier, right, doesn't take a brilliant person to realize I'm injecting trillions of dollars, new dollars into the market, price go up.
Yeah.
Right, and the whole time that they were doing it, they were basically not only doing it as well as the fiscal government was doing, they were joining in. The Fed was joining in, doing it. But then the whole time they're also saying it was transitory, basically saying that,
gonna
don't
go
worry,
away.
we're doing this, but like prices will come down.
Yeah.
Like,
Trust
don't worry.
us. Trust us.
You got us.
Right.
But then obviously that's not what happens. So then they hike rates way too late. And when they hike rates too late, essentially you're on the other end of the cycle. 'Cause it's just all backwards looking, and they just make a shit show for themselves.
They really do.
But we'll keep going because I just wanted to explain that longer run, what he means by that.
Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose
Again,
2.8%.
just take out some of it.
The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as
Sure.
reflected in a broad range of surveys of households, businesses, and forecasters,
Sure.
as well as measures from financial markets.
That's just like okay.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
So you can pause it here.
We're
A little bit on like why this is, or like also like it's really kind of funny that like they mess up so bad and then they say that statement that they care.
Right.
Kind of wild.
Backwards.
But let's just explain why that is very simply of why higher inflation impacts the people not earning a lot versus your top earners, right? So right now your risk-free rate, like you can basically just go put your money, your savings into the U.S. bond, which is essentially the risk-free rate, and you can get 5% a year. So let's say you have $1 million, you put it in at 5% in 1 year, you get $50,000. Okay, $50,000 is for some people a yearly salary, and they just made that risk-free out without doing anything, nothing, right? That's why money makes money. Right?
Yep.
Where on the other hand, somebody else who's lower income, maybe they have $1,000 and they put that in risk-free rate, right? At the end of the year, they come back, they have $50. Okay, well, I think 50,000 versus 50, a little bit different.
Doesn't
right?
do as much,
right?
does
And so like when you go out to the pump, right? For everybody, whether you're rich or poor, it's going to cost $35 to fill up your car, right? It doesn't matter. But so for that person who just made 50,000 risk free, that's before they're even their normal salary or anything. That $35, if it goes up to 40, 50, what do they care?
It's fine.
Nothing, right? The person who has savings, who risk-free made 50 is just like, well,
There goes my year of
You might have a-
risk-free
right,
earnings.
right. So that's why it
One
impacts
tank of gas.
the lower part a lot more. So that's why this whole inflation thing is a serious problem for really
Low earners.
It's basically most of America,
Yeah.
essentially. We have a lot of stats on it, but like it's most of America is living paycheck to paycheck.
Yeah.
So all of those people, that's who this is hurting, where your top, maybe let's call it 20% of America, 15%, maybe even higher. Those people will be just fine, and
Yeah.
they'll just continue to print money while everybody else is just struggling to meet the daily bills. So that's why what he's saying is correct. Yes,
Yeah.
it does hurt, but it's also kind of like, hey, by the way, you caused this.
Yeah.
So, like, how are you actually saying this? Or maybe can you, like, update your process to, like, stop fucking us over?
Seriously.
But anyway,
Anyways, nice Ricci rant.
that's a little Ricci, man. I'm on it today.
You're heated.
Well, I had a soda,
Yeah, half a soda.
Half
a
a
day-old soda.
day old soda.
79 cents, though.
79 cents.
So you did beat inflation.
I did beat inflation.
You found a 79-cent soda.
Dude, so I went into the grocery store, and I was like, there was something blue. So, I mean,
You like blue.
I love the color blue. Everything I wear is always blue.
Wearing blue
I'm
right
wearing
now.
blue right now. To be honest, it says it does well with my eyes, so you gotta keep going.
Oh,
Yeah, I listen. Anyway,
There you go.
so I saw this soda, and on the soda says old-fashioned taste, old-fashioned prices. It was 79 cents.
incredible.
So I grabbed a couple of those, and so had a little bit of a blue soda
Incredible.
before this.
Well, maybe what you're saying is wrong and inflation doesn't exist.
You know what? The soda was pretty bad. So it definitely
Yes,
exists.
inflation's still here.
It's still here. All right, we got time for one little question here. Usually the questions are awful, but we're gonna watch one of them because it was kind of interesting what he says.
Okay.
So
Okay.
let's look at this.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we said is that we need to be more confident, and we've said, my colleagues and I today said that we didn't see progress in the first quarter, And I've said that it appears then that it's going to take longer for us to reach that point of conference. So I don't know how long it'll take. I can just say
Also, when he says longer than expected, that means he's not
when we
cutting
get that
rates
confidence, then rate
for a
cuts
long time.
will be in scope.
or the end of this year,
I
probably
don't know
not
exactly
towards
when
the
that
end
will
of
be.
this year,
Yeah.
so
And
rates are gonna
with
stay high.
hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March that suggested something more worrying than just expected bumpiness?
Wow.
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months data, but this is a full
Pause it
quarter.
there.
And I think it's
So you may have just missed what he just said. I think a lot of people are
did.
talking about the pause, but I really don't care about the pause. I'm thinking about, like, how does this man think?
Yeah.
He just said to us, I had to see the last 3 inflation reports to predict out tomorrow's policy.
Right.
Your CPI report is already lagging probably by a month.
Yep.
So you wonder why the Fed is always wrong? They're looking at 3 past CPI reports to tell you what to do tomorrow.
Yeah.
Who looks at the
How does that make
past?
sense?
Like it's like, imagine I came to you and I was like, and let's say a company went bankrupt 3 months ago. I was like, I'm going to make an investment in this company. You're laughing at me like, Brian, the company's like, it doesn't exist anymore. Well, what do you fucking mean?
Yeah.
Right? That's what you literally just said to us.
Yeah.
Right? So so this is why it really kind of infuriates me, because like he acts like CPI is something that like it just like lick the finger, let's see where this goes. It's just like, it's not like that whatsoever. So if you go to the next chart, like the main thing, it says crude oil on it, right? The main thing in terms of inflation, like you can kind of just watch crude oil price. I mean, it gets really complicated. We're going to get through it, but crude oil prices.
Sure.
Okay. In order to run your economy, you need oil, right?
Energy.
You want to build something? Well, you have machines. How do you run machines? You need oil, right? You want to go in an airplane? Oil. Shipping? Oil.
Right.
Car, like diesel.
everything.
Everything runs on oil.
Yeah.
So if you're going to predict out what inflation does, you can just pull up a chart of crude oil, and all this chart is showing you is what the prices did from January to March. The prices went up 21%.
Yep.
So guess what's going to happen? Inflation's now going to run through your system. Because if the crude oil is your input cost, crude oil is an input cost to the next thing. Whatever you manufacture, the price is going to go up.
Yeah.
Because you used oil at an inflated rate. Go through it. So we'll
Yeah.
go next to like fertilizers. Like, what did you see in fertilizer costs? They did the same exact thing. They went up 20%.
Yep.
Right? But again, this is all structural. Like, it all exists. You don't have to be a genius to figure this out. So what does fertilizer lead? If you go to the next slide, it leads your corn prices, your wheat prices. So you can see there with the green line, the green arrow is that's that recent ramp up
Yeah.
in fertilizer. So when that goes up, so what happens 12 weeks later? Wheat goes up, corn goes up. What does corn and wheat go into, or soybeans? That's how you feed your animals.
Yeah.
So your lean
Livestock,
hogs, your cows,
Price of
your
meat,
beef,
I'm sure.
that goes up on a 24-month lag. So that by the time he gets to it and realizes you have inflation, the prices are already going through the system.
Yeah.
Right? So he's already late.
He's looking at the wrong things, is
You
basically
have to
what
look
you're
at
saying.
today's data to predict out the future.
Which leads all these things that
It
influence
leaves out
price.
everything. And let's go to the next slide, because you know what's even worse than all of that? That's essentially like, let's say shipping costs, by the way. I almost forgot that one. Those went up in January about 110%. And that's going
Perfect.
to impact late 2024 CPI, right? We detail all this out in our macro themes, but
Yeah.
this is all going to happen.
Yeah.
You go to the next one here. Oh,
Yeah.
by the way, metals. You want to build anything, manufacturing, right? Like, imagine like a producer of a building.
Yeah.
You go up to him and say, how much is this going to cost? Well, you know what? I got to go look at the last 3 CPI reports to give you an estimate of what this is going to cost.
Yeah.
You laugh in the guy's face. He's
Yeah.
going to go to the shop and say, oh, this is what my costs were to build this. This is how much you're going to have to pay.
Yeah.
So when stuff like this goes up, you know what's going to happen next. Inflation's going to go up.
Yeah.
This isn't
not
rocket
rocket science
It's
at
really
all.
not rocket science.
No.
But go to the next slide. What's worse than all of this? Okay. So this is what's worse than all of that commodity stuff, right? That's just like, that's already happened. That's going to flow through the economy. Nothing you can do about it,
Yeah.
essentially.
Yeah.
Right? What's worse is your fiscal side, your fiscal government. If they're spending money, the price of things are going to go up. So what you're looking at here is your debt, U.S. debt. So U.S. debt's currently at like, what, 33 trillion. This is the CBO. This is our estimates of where debt is going to go in the next 20 years. Where does it go?
Straight up.
Straight up.
Straight up. If nothing changes, straight up.
Straight up.
Not good.
So that's where inflation's going.
This assumes no wars, recessions, or shocks of any kind.
Yeah.
Oh, wow.
Oh, yeah. Good, good, good. That's great, right? So that's where inflation's going. Go to the next slide. Let's just put this into perspective of debt to GDP. Everybody like always says, yeah, you know, Greece, Italy, right? Their debt to GDP, like they're spending out of control,
Yeah.
right?
We're
You know
right
who
there.
the third worst country is?
Yeah.
The United States of America.
We are right there.
And we're going to keep this going?
We're going to be down there pretty soon.
Oh my goodness. So basically, like, we'll get to that.
Oh, sorry.
No, you're good. So like when you see all these stuff on the airwaves, I think that they call that TV nowadays. That's a good one. Anyway, when you see stuff like more aid packages, they're cutting student loans. That's all. Where's that money come from? Debt.
They print it.
They're printing it. So they're increasing that deficit. So that's all going to be inflationary. So that's really where you want, like, that's not
That's where you
good.
want to focus.
That's really not good. So if your fiscal side is printing like they're doing right now, inflation's going to go up.
Yeah.
Okay, so now let's go to that next slide here. So let's just do this is quick maths on what base effects are. Okay, this is CPI year over year. So you see that 3.5%. That's where inflation is today. So, right, when you do CPI, right? So your headline number. So if you go, your numerator is today's prices. Denominator is last year's prices.
Right.
So essentially the denominator there is 5.
Yeah.
So as the denominator goes down, headline goes up just naturally. Let's say you don't do anything differently, just like that. So that blue, it goes down to where it's going in June, just naturally, prices are going, like headline inflation is going to go up.
Yeah.
That's without doing anything. But oh wait, right, as we just showed, right, with crude oil, fertilizer, all this stuff, inflation is going to go through the system.
Yep.
So already that's going to be inflationary.
It's already coming.
So it's going to be coming. Your fiscal government's going to be spending a lot,
Yeah.
a lot more. It's going to go push it up even higher.
It's a bad setup.
So that's where we get this whole idea of higher for longer and rising.
And rising.
Right? Is because even if they did nothing, your base effects are going to push inflation higher. And what are they doing to stop that from happening? They're not raising rates.
They're not gonna
They're
raise
not even
rates.
talking about raising rates. They're just going to hold them steady.
They're going to hope.
And they're going to ease quantitatively. So that's going to push them up even, like a little bit more.
Yeah.
So basically they're doing nothing.
They're doing nothing.
And the whole reason is because they're looking at
Lagging data. They're looking at data from 3 months ago.
data from 3 months ago.
Instead of
to
what's
predict
going to happen.
Instead of what's about
definitely
to go
going to happen.
And that is why your Fed will always be wrong no matter what they do and what they say.
Until they get a better process, they are going to be playing catch up.
Yeah, it's pretty crazy.
Yeah, it's
Or they
concerning.
just kind of, I mean, what's even more concerning is, right, they have 756 people that work at the Fed to
Yeah.
predict out inflation. The
Yeah.
fact that not one of them can, like, raise a hand and say, hey, like, you know, crude oil prices, the thing that runs the economy, we might want to start looking at those.
Yeah, maybe.
Maybe,
Maybe
but,
a little bit.
But it'll never happen. So that's
Of course not.
all I really wanted to go through. And
Well,
that's-
you have thoroughly frightened me.
you're welcome.
Thank you for that.
You're welcome. I'll be here all week for that.
I can't wait for the next FOMC meeting where I can get even more scared. That was like a horror movie. So thanks for your time, Ryan.
You're welcome.
I appreciate it.
Thank you.
And now I think I get it now.
You're welcome.
Awesome.